I just want to do a quick video on paying points or not paying points. A lot of times we get pre-approved, we look at general numbers, and then of course we've never thought about interest rates before. And all that's on our mind is all of the different companies marketing interest rates to us. For example, one of a household name everyone knows, Quicken Loans. We see them on Super Bowl commercials and everywhere. Right now, today, in this example, they are quoting their 30-year fixed mortgage rate to be 6.75%. Now, if we go into the disclosures, if I just click this breakdown, well, now it tells us right down here a 30-year fixed loan, 6.75%, is going to cost you 2 discount points. These are kind of the hidden fees that you need to be watching out for. A lot of lenders don't like to explain this stuff and just kind of like pull the curtain up and give you the full transparency. They just like to market and throw you into the lowest interest rate possible, thinking you likely won't ask any questions and you'll just move full speed ahead feeling good about your loan product. Here's a quick calculator. So let's say your loan amount is $450,000 and the interest rate without paying points, we'll say it's, if that was 6.75, we'll say it's 7.25 over 30 years. And then we calculate down to the interest rate if you do pay the 2 points that they talked about. And just to explain it, 2 points means 2% of your loan amount in fees. So that adds up to be, here's a comparison. No points, 7.25, your monthly payment is going to be $3,070. Well, if you have a lower interest rate, of course, your monthly payment is going to be less, $2,919. That's $151 a month less. It's pretty significant. But because you spent that upfront money paying down the points, how long until you actually are saving that money or breaking even on your initial investment? 60 months. 60 months is a pretty long time. The average American is only in their home for about 6 years, whether they end up refinancing or selling their home. In a market where interest rates are higher and we expect them to go back down, if you end up refinancing, any money that you spent on extra fees up front, that all is money you could have just lit on fire in your front yard instead, because you never can recoup that cost. You don't get that money back if you sell or refinance. So 60 months is a pretty long time to invest money to only save $151, not for years and years down the road. If you have any questions about this or want me to run some more scenarios for your specific position and specific loan amount, reach out. I'd love to help.